All right. I think that we've got some folks in the room and we'll get going. Um, to respect your time, I want to say hello and greetings. Thank you, everyone. My name is Jenna Bella. I am the Deputy Director of Digital Product at Economic Policy Institute. And I want to welcome you to EPI's first webinar of 2026, What is Missing from the Affordability Debate? Thank you so much for joining us. In the wild world that we live in right now, we deeply appreciate the gift of your time and attention and your participation today. This is actually the first in a series of EPI events coming up this year, and we are thrilled to be playing to a packed house on opening night. A few details before we get started, just so everybody knows kind of how we're operating. And I turn you over to our panel. Thank you for your patience in advance as we get our webinar legs underneath us. Please feel free to message the hosts and panelists through the chat if you're experiencing any kind of technical difficulty or you have any questions that you would like to pose to the panelists. Hopefully, we can get to them at the end. We are recording this event. We're going to share it with you in a follow-up email next week, along with any links that get mentioned, so you don't have to worry about taking anything down from the chat or whatever. And with that, I am going to turn you over to EPI's Director of Governmental Affairs and Advocacy, Sam Sanders. Take it away.
Thank you so much, Jen. And hi, everyone. Thanks for sharing part of your afternoon with us. I'm excited to be here. As Jen mentioned, I'm Sam. I use she, her pronouns. I am on the policy team at EPI, where I work on our federal government affairs work and other advocacy. And I'm very excited to introduce three of my colleagues to you today. They're all brilliant economists, and I'm lucky to get to work with them. Joining me, we have Heidi Shierholz. She's the president of EPI and formerly the chief economist at the US Department of Labor in better times. I'm joined by Valerie Wilson. She's our director of the program on race, ethnicity, and the economy here at EPI. And finally, Josh Bivens, our chief economist at EPI. Thanks again for being with us today. So before we kick off this discussion, I wanted to provide a little context for kind of what's going on. What is the affordability debate? Many of you are probably drawn here today because you're interested in this very question and you've heard some of the discourse about it yourselves. So there have been very recent, successful, and high profile gubernatorial and mayoral campaigns in New Jersey, Virginia, and New York City in 2025, which all had affordability agendas at their center. Democratic members of Congress have been hammering the Trump administration on this in recent months and talking about their own policies to make things more affordable. Senator Schumer just previewed a new plan that the Senate Democrats will be rolling out last week on housing affordability and housing costs, with more to come over the course of this year. Cost of living was kind of a key issue and phrase in the 2024 election. That's kind of out. Affordability is in political discourse and policy conversations. And then, just to show you how far this debate and this issue has spread, I'll say a few phrases here: lowering costs, tackling housing affordability, emergency price relief, price fixing in the food supply chain. You might guess that these would be phrases from a progressive populist playbook, but in fact, those are all phrases pulled directly from Trump White House press releases and fact sheets in recent weeks. And we know the reality, of course, is that Trump's policies are actually making life less affordable for everyday Americans. EPI just put out a report on this from some of my colleagues about how Trump's actions are actually lowering wages and economic security, weakening workers' rights. But the Trump White House, their administration, and the Republicans are also clearly feeling the pressure and the heat on this issue, and they're taking notes on what is working for those on the other side of the aisle for how to talk about it. So to step back from this kind of political polling messaging space, we want to dig into some of the details. So I'll turn to Heidi first. What does affordability really mean to you in economic debates?
Okay, welcome everyone. Thanks so much for coming. And Sam, you said it, affordability is the new buzzword in the public conversation about the economy. And I will say honestly, as far as buzzwords go, it's not actually terrible. It really does get at something important about what the economy is delivering for working people. Basically, affordability is whether things that make up a dignified life, food, housing, utilities, healthcare, childcare, transportation, education, whether those things are within reasonable reach for working people. The problem with affordability as a buzzword is that pundits are talking about affordability almost entirely in terms of prices, as if the only way to make life more affordable is to make things cheaper. But affordability depends on both prices and income. Whether your life is affordable is driven by whether you have enough income to cover the cost of the things that you need. So there are those two sides to the affordability equation. And I just want to clarify, when I say income, I mean largely, but not entirely, wages. So the vast majority of non-retired people do not have wealth that is earning them any meaningful amount of income. So the vast majority of families get the vast majority of their income from wages, from what they earn in the labor market, and to a much lesser extent from public goods and benefits. So thinking about affordability is as not just about prices, but as a race between prices and pay is an economically coherent way to think about affordability. And you can just look at the experience of working families over the last two business cycles to see why focusing only on prices is not an economically coherent way to think about affordability. Focusing only on prices gives a totally distorted picture of trends in affordability. So, for example, if you focus only on prices, you would think households in 2024 were far poorer than they were in 2019 before the pandemic, and in particular, the post-pandemic surge of inflation. But that is actually wrong. Wages rose a lot. They rose more than prices between 2019 and 2024. And that was especially true for the lowest wage workers. Like, remember the great resignation. Like, working people were quitting jobs left and right to take better jobs with higher wages. Wages absolutely surged during that period. And if you account for both prices and wages, i.e., if you look at inflation adjusted or real wages, affordability actually improved for working people during that period. And whenever I talk about that, I always want to clarify that I am not saying that things were great for everyone in 2024. There was still a huge gap between what the economy was delivering for working people and what it could be delivering for working people. Full stop. What I am saying is that accounting for both what things cost and what people earn, life was more affordable for working people in 2024 than it was in 2019. And by contrast, you can look at the prior business cycle and the years between the Great Recession and the pandemic. That period saw totally tame inflation. Inflation averaged less than 2% per year over that period, but those years are hardly remembered as a golden age for working families because pay growth was so sluggish for most of that period that real or inflation adjusted wages grew very, very slowly. So I will just end there by saying that I think if people take nothing else from this webinar, take the point that affordability isn't just about prices. It is about prices and incomes. The wages working people earn are at least as important to affordability as the prices that they face.
Thanks for that context, Heidi. I'll turn to Valerie, but I'll feel free to weigh in. Why do you think affordability is becoming so sticky at this moment?
So I think in the last few years, we've all witnessed this growing divide between what the macroeconomic indicators are telling us and how people are feeling or experiencing the economy. I think the word affordability just does a really great job of capturing that general sense of economic anxiety that's closely associated with the sharp rise in prices that we saw during the pandemic at the end of during the early 2020s. Now, I think it's also pretty obvious to everybody that nobody wants to pay more for anything. I think that dissatisfaction is only amplified if you've seen a price hike in something that you need. If you have a recent point of reference for that thing being a lot cheaper, and you're constantly confronted with the higher costs because you have to spend money on it on a regular basis. So think food, your utility bill, rent, all things that we have to confront a higher price on a regular basis. Now, while we as economists geek out over the economic data and we like to consider a lot of different metrics to evaluate the health of the economy, the average person is only assessing the economy based on what is most immediate and most tangible to them. And as Heidi already laid out, that comes down to, can I afford a decent life? I think there's a sense that when prices go up, the goal line for that decent life has been moved, and I, as an individual, have no control over that. On the other hand, if my wages increase in a way that enables me to improve my standard of living, then I think of that as, okay, I earned that. I'm being rewarded for my skills and hard work. Right now, I think people are saying, I'm doing the best that I can, and I still don't feel like I'm getting ahead because I'm spending more at the grocery store and I have a lot less in my cart to take home. So that pinch people are feeling comes down to them recognizing, this isn't my fault. So I need you, Mr. President, Madam Governor, Senator so-and-so, to do something about what I'm feeling about this economic pain that I'm experiencing. And in that way, I really think affordability has been an effective tool for calling policymakers to task. But the truth is that policymakers have much less control or much less power to affect specific prices than they do to affect wage growth. Wage growth is driven almost entirely by policies. And remember, nobody likes to pay more for anything than they have to. That includes employers. So a worker's hard work and skills only go so far to driving wage growth. Strong wage growth is supported by policies that boost workers' leverage and bargaining power by raising labor standards and wage standards or fostering unionization and by keeping unemployment low. On the other hand, when wage growth is weak, like it has been for many workers for much of the last several decades, it's not because workers aren't working hard enough or they lack skills and motivation, but because policy in many ways has undercut their ability to get higher wages by not raising wage standards, making it harder for folks to unionize, and failing to generate consistently low unemployment rates.
Wait, Sam,
Thanks for that.
do you care if I jump in really fast to add one
Please,
thing?
go ahead.
I know I said before that if you take nothing else from this webinar, I hope you take the point that affordability isn't just about prices, it's about prices and pay. But given what Valerie said, I want to add one more thing to that, and that is that pay as a policy choice. Like, as Valerie said this, but most people don't understand that wages for working people are totally dependent on policy choices. So, like, as policymakers move ahead, we need to remind them, and they need to remind working people over and over and over again that pay is a policy choice and that they are taking action to get people bigger paychecks. And they are doing that because affordability happens when working people earn enough to cover the costs of living with dignity.
Thanks for that, Heidi and Valerie. I mean, Josh, I want to ask you to weigh in on this. I think Valerie also brought up a lot of these points. Could you build on why you think it's a risk to actually focus too much on price, to have the balance tilted more toward price related solutions versus wage ones when you're looking at how to address these problems?
Yeah, and it's mostly going to be reiterating what's said, but what's been said is valuable enough to reiterate. I would say one, focusing only on prices will just give you a wrong idea about when living standards are actually rising versus falling. That's a problem. And then two, focusing too much on prices will kind of narrow the playing field of what policymakers think they can actually do to boost people's living standards. And so, Heidi just gave the example, like 2019 to 2024, inflation was very high, but wage growth adjusted for inflation was also very high, and it was particularly high for the lowest wage workers. And so in that sense, like if all you did was look at the inflation, you'd have a very bad idea about what happened sort of affordability and living standards over that time. And I'd say going forward, this is really important. We are almost surely going to see inflation kind of slow down a bit in coming years, particularly inflation in housing. And if that's all you knew, you might say that's just mean it's going to be really good for working families. And it's probably not going to be very good for working families because at the same time we're seeing inflation likely to relent in the next couple of years. We're seeing the labor market weaken a lot, and people's ability to get decent wage growth is also weakening. And so I think that's going to be bad on net for affordability, even as inflation slows down. Looking only at prices will make you miss those dynamics. And I'll just preview here. We are next week going to have some analysis of what actually happened to wages in 2025. And we're looking at that, and affordability got worse in 2025, even as inflation went down, because the labor market weakened enough to actually pull people sort of under. And then finally, I'll just say policymakers are, well, I think Valerie's point was really good. Policymakers are too primed to think that inflation is inflicted, or I think people are already too primed to think that inflation is a problem inflicted on them by policymakers, but don't think those policymakers can do anything about wages. I think that's a really bad outlook. And then I'll just say one thing as well that I think is useful here to talk about. If you focus only on prices rather than the income and resources available to families, you can get yourself into weird positions. And so take the example of childcare and healthcare. These are two things people have huge affordability problems for. We should do something about it at a policy level. The problem with childcare really isn't that we want its price to be much, much lower. Like the price of childcare is overwhelmingly the wages of childcare workers. The wages of childcare workers are already too low. They actually should be higher. There's not huge profits in childcare. There's not huge technological investments that make it expensive. It's just expensive because it's expensive to hire a person to just like watch your kid for an entire day. And so what we want to do with that is give people more resources. When they have young children, we want to have subsidies for childcare. We want to provide it publicly. But just pounding down its price isn't really the way to go. If you think about healthcare, it's a combination of all of this. Like it is just too expensive. The American healthcare system has all sorts of monopoly power and corporate profit seeking and technological investments that make it way too expensive relative to other countries' very good health systems. But even if we had like an incredibly efficient health system, basically French healthcare, much more efficient, much less profit seeking, it would still be too expensive for many, many families. And we should do something to help them access it, which is transfer resources to them. So I just think looking only at the price side, you just miss so much of what's going on with the objective reality of people's standards. And you just consign yourself to this narrow part of the policymaking playing field in a really unuseful way.
Thanks for that, Josh. I want to ask one other question to kind of continue building a shared understanding of the problem, and then we'll move into maybe talking about some specific solutions, which I know folks have questions about. Valerie, I'll turn to you. Can you talk about what the affordability challenge looks like for different groups in the U.S., right? Different groups of workers, different types of families and households, since that would point toward what kind of more targeted solutions we need.
Sure. So as we've defined it, affordability is a race between prices and wages or income. And since, with few exceptions, most of us face the same prices as set by the market, affordability concerns for different workers track closely with established patterns of wage, income, and wealth inequality. So what does that mean? Based on the large and persistent gender and racial disparities across each of those measures, the affordability crisis is an all too familiar issue for many women-led households, for families of color, and also for seniors who live on a limited fixed income. These are also groups that we know experience higher rates of poverty, and that we commonly, when we're referring to those groups, we're talking about it in the context of poverty, but poverty is an extreme affordability issue. I think the challenge is that the discourse on affordability sounds very different from what we typically hear in the discourse on poverty. Affordability is being framed as something that it's not your fault. Somebody in power should do something about that. But the discourse on poverty is largely framed as there must be something that you're not doing right. You need to grab a hold of your bootstraps and work harder to fix it. And then that quickly devolves into all kinds of dog whistling and racialized stereotyping about why people are in a certain position. Poverty is just an external condition that means you have insufficient income to meet a basic set of material needs. And again, as we've defined it, that sounds a lot like affordability to me. My hope, as we get into the discussion about policies, my hope is that broadening the discourse on affordability to focus more on wage growth and income supports, that will lead to the kinds of policy solutions that address economic inequality and disparities without all of the unwarranted, racially tinged shaming and blaming that often stigmatizes anti-poverty measures and our discourse on poverty.
Thanks for that. That's really important. And I think really important to not lose sight of what many groups, especially those households in poverty, have been experiencing for a long time before it became kind of the discourse of the day. I mean, I want to move into talking a little bit about policy solutions, right? We're talking about the need to focus on wages, raising incomes to address the affordability crisis. What do those policies look like? And I'll turn to Heidi to start. I hope Valerie and Josh can jump in as well. But Heidi, if you could also speak specifically to the fact, we know the situation with Congress, we know who's in the White House. What can states be doing to address affordability as well, with real policy solutions and potentially the absence of really any meaningful federal action?
Okay, yes, I would be happy to. And I will talk about what states can do, but because of the questions that we're getting in the chat that's going to host some participants, I'll also talk about some things that states can't do, but that can
Yeah.
affect that the federal government
Yeah, I
can
think
do.
federal and state. So
Federal,
yeah.
okay, but I'll start with states. States can absolutely address affordability. So for one, they can raise wages, and here's things that can raise wages by doing things like increasing the minimum wage and strengthening other labor standards like overtime protections. So strong labor standards raise wages, and just as importantly, given that labor standards are only as strong as their enforcement, states can strengthen enforcement of those standards. Literally, tens of billions of dollars are stolen from working people in the form of wage theft every year. Like workers not being paid the minimum wages they are owed, workers not being paid the overtime they are owed. So, stronger enforcement really, really matters to affordability. States can also do things to make sure the environment in this state is as friendly as possible to union organizing. Unions raise wages, so they are really important to affordability. States can do things like eliminate anti-union, so-called right to work laws. They can protect workers' right to not attend captive audience meetings. They can ensure full collective bargaining rights for public sector employees, for farm workers, for domestic workers, all of whom are excluded from the National Labor Relations Act. Um, and here's where I'm going to divert and talk a little bit about something that the federal government can do, but not states, just because we're getting these questions in the chat. So this is a little bit of a diversion. But one thing that is really important that states don't really have control over, that is macroeconomic policy to keep the unemployment rate low. That is the Fed setting interest rates to keep unemployment low. Congress doing fiscal stimulus to get us out of a recession or a weak labor market when the Fed's tools aren't enough for one reason or another. Those things, keeping the unemployment rate low is really, really important to wages. And here's I think, a useful way to think about it. A high unemployment rate doesn't just mean people don't have jobs. It also lowers wages. When your employer knows you don't have outside options, when this job they have given you is your only chance at a job, they do not have to pay decent wages to get and keep the workers that they need. So high unemployment hurts wage growth, low unemployment strengthens wage growth. And that's something that like national macroeconomic policymakers do have control over. Okay, back to states quickly. States can also use progressive taxation to fund the expansion of public goods and benefits. That raises incomes and addresses affordability in that way. So a couple of examples, they can expand social insurance and cash supports like state earned income tax credits, state child tax credits, paid family medical leave, more generous unemployment insurance, et cetera, et cetera. They can fund universal or heavily subsidized childcare and pre-K. They can provide free school meals. They can provide free or reduced fare public transit, and on and on and on. So even in the absence of federal action, states and localities really do have many tools to address affordability by raising incomes, by strengthening labor market standards and institutions, and by expanding public goods and benefits.
Thanks for that overview, Heidi. Actually, that's a really great overview of some policies that are really targeted at wages. I want to ask about policies, and this is specifically maybe for Valerie to start, but policies in a few of the areas that come up most commonly, including in your all's earlier remarks about difficulties with affordability, and that's specifically healthcare and housing. We know that we've recently, officially at the end of 2025, the ACA tax credits expired, the Affordable Care Act subsidies that were helping folks afford their premiums. So healthcare premiums are spiking for many people. Could you speak a little, Valerie, maybe to start, and then Josh may also want to weigh in on how public health insurance, maybe one day public childcare provisions, which Josh mentioned earlier, fit into this debate. And then I also want to ask about housing. But can we maybe talk about healthcare first and where you see that factoring into why so many folks are focusing on affordability right now?
Yeah, so I think, we think about what, ACA stands for. It literally means Affordable Care Act. So that's a huge, signal that healthcare is very important, and having reasonably priced health insurance is very important to this issue of affordability. It's also true that the ACA tax credits are a prime example of a policy designed to boost the income side of the affordability ledger. Those credits are basically an income transfer to families that make purchasing health insurance much more affordable. In 2021, families received another boost when the Biden administration expanded those credits. It's that expansion that has since expired. And mind you, after a prolonged government shutdown aimed at urging the current Republican-controlled Congress to keep the expansions in place. They chose to let those expire anyway. And the consequence of that has major implications for working families. The rollback of the credits will double the out-of-pocket cost facing the 20 million Americans who buy their health insurance through the health insurance exchanges. And it also takes about $30 billion per year out of the pockets of families that could have been used to buy health insurance coverage. And we know that without that coverage, families are basically just one major health event away from a financial crisis, or worse, a preventable death. These shocks, we talked before about how it impacts different workers. These shocks will be acutely felt by many Black workers and their families due to some long-standing structural inequities that limit access to affordable health care and perpetuate racial health disparities. Based on some joint EPI and Groundwork Collaborative analysis of the impact on Black families of allowing those ACA credits to expire, across 10 major metro areas, Black families would pay an estimated $740 million more in annual premium costs. So that's real money for people. And that's just looking at 10 major metro areas. But the other thing that I sort of want to circle back to as we were talking about policies and what states can do, I think it's important to understand there are things that states can do. And we also need to understand that there are states that maybe will never do those things or will fight really hard not to do those things. And so in that context, it remains important that we have strong federal policies that also support wage growth and help to make life more affordable for all of our population. If it's not clear, the states that are less likely to do those things are predominantly southern states. And that's where the majority of the Black population resides in this country. So we really do need really strong federal policies on top of the things that states can do to enhance or improve upon federal policy.
Absolutely. Could I ask, and maybe Valerie to start, but even if housing prices and inflation do relent in the coming years, it's clear that housing prices, in addition to healthcare, are one of voters' key concerns in the near term. I think maybe both Valerie and Josh might want to weigh in on this, but can you speak a bit to what you think policymakers should do in the short term on housing costs? And maybe you want to weigh in also on what Trump is trying to do recently to address housing prices and what effect that might have.
Yeah, so the housing price spike that we saw during the pandemic really catapulted housing affordability to like a major concern, a major part of our political discourse. That spike was largely a one-time event as a result of the pandemic, increasing demand for housing as more people were working from home. In the short term, the best policy lever for addressing housing affordability is public benefits. That was obvious during the pandemic relief response because that included rental assistance, specifically giving people money to help support covering their rent. So the easy thing to do in the short term would be just don't cut rental assistance. An even bigger sign of good intent as it relates to wanting to support housing affordability would be to actually expand or increase rental assistance. I think the administration has already sort of messed this up by doing the complete opposite. They have cut rental assistance and public housing. The cuts to SNAP include the parts of SNAP that can be used to pay for energy assistance. And related to energy and utility costs, they also cut funding for the Green and Resilient Retrofit program that paid for weatherization, and that weatherization helps to reduce utility bills for lower income households. So again, I would say the Trump administration gets a failing grade on their short-term response to housing affordability concerns. But in the medium to longer term, they need to make sure that conditions are good for building new homes. We need an increased supply of housing to help support affordability. Now, those kinds of conditions that make that easier to build more homes and expand supply is something that is harder to change or impact quickly. But one obvious set of conditions would be interest rates. And as much as Trump just tries to bully Fed officials into doing what he wants on interest rates, his policy actions aren't helping on that front. I find it hard to make sense of Trump's housing agenda, much less follow along with the changes and conflicting messages. But Josh tends to be much better at tracking and explaining all those contradictions. So, I'd love to hear his take on this as well.
Yeah, Josh, do you want to weigh in on that? And maybe specifically, I mean, going back to what I said earlier, if you want to talk about some of the things that Trump has been saying that could be pulled out of, a much more left-leaning politician's playbook, even if it doesn't align with his actions, things like wanting to do stuff about, large investors buying up single-family homes or talking about mortgage interest rates a lot, and that kind of thing. How does that square up with what's actually happening?
Yeah, I'll say a couple words about this. It's going to be hard to make any sense of it because it's underrated how chaotic to call it a housing policy is sort of already too nice. It's almost as chaotic as sort of their trade policy and how all over the map they are. I'll just circle back 1 second on healthcare. I would say we've focused a lot of attention on the ACA premium subsidy extensions, which we should. They're really important. I mean, the centerpiece cost saving of the one big beautiful bill that made way for big tax cuts, mostly to rich people, was cuts to Medicaid, which is one of the most important sort of public programs we have in this country, provides health insurance to low income people as well as elderly people when they have to seek long-term care. Huge cuts, more than $800 billion over 10 years. Like it is the definition of how to make one of the most important parts of life incredibly less affordable for the most vulnerable people, which is sort of a recurring theme again and again in that legislation. On the housing issue, I would mostly say he basically just goes back and forth on this issue in ways that are directly contradictory. Like in his first term, he often came out strongly against measures that would allow more density and more supply. He would tweet stuff like "save single-family homes" to sort of stop zoning reforms that would allow more density and more supply. Since then, he occasionally tries to pose as kind of an abundancy pro-building person, emphasizing zoning reform and manufactured housing, but there's zero meat on the bone of actual policy substance there. I would say the other big policy whipsaw, and I won't go into much detail about this, but it's basically like their decisions about what to do with the government-sponsored housing enterprises, Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac started out, well, Fannie Mae anyway, as a public institution. It's why Americans can buy a 30-year fixed mortgage, which most other countries cannot. It really did support home ownership in this country. It was quasi-privatized, and then it got remade a public institution after the sort of Great Recession and taken into federal government conservatorship. And so I think it belongs as a public institution in something like a public utility that ensures people can have like stable, low mortgage rates. There is a big push to reprivatize it, which would be a big benefit to a small number of billionaires who are advising Trump. They seem to be going back and forth on that. Like they want to do a favor to billionaires for sure, but they also like having control of a huge pot of money that can sort of buy mortgage-backed bonds and lower interest rates maybe. And so I think that's another sort of source of uncertainty into the housing markets that has not been super useful. And then I will say they are really good at picking up like the most populist sounding policy. And so you just mentioned one, are we going to ban, bar, restrict the purchase of single family homes by large institutional investors? I would say two things. One, as with everything else, boy, I'd love to see the follow through on that. I'm not holding my breath. And two, of all the things you could do that would actually boost housing supply and put some downward pressure on rents and prices, I think that one is very much overblown, which I think is sort of the point for why they picked it, the one with the biggest sort of populist splash, but will do the least to actually make more homes available and put downward pressure on rents.
And could I actually just ask one quick follow-up on that, Josh? Because I know this is something that you and others at EPI have been thinking about before Trump was talking about it, what, the large investors' concerns about private equity buying up single-family homes. And I think we definitely have like a shared understanding that some of those trends are concerning, particularly in maybe certain geographic areas or whatever. But can you just speak a little bit? Because, I know a lot of our audience might actually be supportive of those policies. Can you speak a little bit to why you think that unfortunately it will have limited impact?
Basically, because we're starting from an incredibly low base of those kinds of investors having a lot of sort of the housing stock. And there's sort of two sides to that. Like on the one hand, it would be bad if powerful economic actors got anything like a monopoly in a given neighborhood in terms of homes for rent. That would be clearly bad. We're very far from that, except maybe in some places like New York City, where that has been the case for 50 years. And so it wouldn't be a big change. And then on the other hand, having a bunch of money come in and think about buying new homes that would then be, or building new homes that would then be available to rent out and increasing housing supply is not the worst thing in the world. Like one of the big impediments to having more homes built in the United States is on the finance side. Not enough people with big pots of money willing to step up and say, we think it's going to be profitable and useful to build more homes. And so I think all those considerations cross-cutting says to me, this is not the housing affordability silver bullet that it can sound like. There are many other markets where sort of the power to set prices due to corporate concentration, I think are much more real than they are in the housing space.
Gotcha. Thank you for indulging me on that. I just know it's a common question we get about our kind of view on that. Heidi, can I turn to you? We've talked about a lot of policies here on areas where prices are particularly high, but there is one kind of bucket of solutions that we have not mentioned or not spent as much time on yet today, which is about antitrust. Can you say a little more about what antitrust is and why others, why many have talked about it as a way to try to reduce prices, but why there's some caveats to that approach as well?
Yes, antitrust is a really interesting case here. So just to back up for a second, the traditional idea of antitrust enforcement is that it keeps prices down by preventing monopolies or other extreme forms of corporate concentration. So basically, by preventing corporate concentration, antitrust preserves competition, which means firms have to keep prices low enough to attract consumers away from their competitors, rather than having the case where huge firms either acting alone or sort of in cahoots with each other, rather than having them be able to set prices high because consumers don't have other options. So that's the basic idea. And I can give you like an example. Antitrust enforcers might block a merger between two giant grocery store chains if the merger would leave many communities with only one grocery store, because that merger would mean consumers would only have one option in those communities, so the store could jack up prices. So that's like the idea of antitrust enforcement, but an important and much less well understood dynamic is that corporate concentration also shows up as wage suppression, not just as price increases. So here's that idea in its sort of most basic form. When a firm is the only one of its type in a community, that firm, as we just said, can jack up prices on what it sells because consumers don't have outside options, but it can also tamp down wages for its workers because its workers don't have outside options either. Like when an employer knows that workers don't have outside options, when there's nowhere else for them to work, the employer doesn't have to pay them decent wages to get and keep the workers that they need. So antitrust policy can actually have an impact on both sides of the affordability equation, both prices and wages. I do want to be clear that that does not mean that antitrust is a silver bullet by any stretch of the imagination. There are a ton of moving parts, and corporate concentration is just one of them. But robust antitrust policy is still an important lane in solving the affordability crisis.
Thanks for that, Heidi.
Mhm.
I want to ask Josh a quick-ish question here, just because I know it, again, similar to antitrust, it's something we haven't mentioned yet, but I know comes up a ton when people are thinking about affordability in 2025 and what to expect in 2026. Tariffs and prices, are they impacting them? How?
I would say, I think the most important bit first is say asking about tariff effects on prices is just another case study and why a prices only approach to affordability is too narrow, just in the sense that, yet tariffs raise prices. But sometimes that's fine or even good. Like you can imagine a case where imports were gaining huge market share and driving out domestic production in some sector, but maybe these imports' cost advantage stemmed from some big economic inefficiency or unfairness, say wage suppression stemming from a failure to protect labor rights in the exporting country. In that situation, using tariffs to sort of try to undo that artificial cost advantage and push the exporting country to improve their labor standards could make a lot of sense and lead to higher wages abroad and even alleviate some wage suppression in the US. So that'd be a good and strategic use for tariffs, even if they raise prices. I would say the policy we've gotten over the past year and going forward under the Trump administration, though, has not been a strategic and targeted use of tariffs like that. It's just been very chaotic and random and personality driven. And I think there's been a noticeable effect on prices. Goods prices were falling in 2023 and 2024. Right around Liberation Day, they stopped falling. And I think the effects could get larger if the tariffs survive the challenge in the Supreme Court. I think a lot of firms are like, maybe we don't have to raise our prices and annoy customers if these things are going to go away anyway. And so I think with the Trump policy, we've gotten some upward price pressure from the tariffs, and we just have not gotten any countervailing benefit because they were part of like a strategic and useful policy generally. They were just the price increases without a lot of gain.
Totally. Thanks for that. Valerie, I want to turn to you on one other question, and then I want to get to questions from our audience because we have so many, and I want to make sure we have time to address some of them. Um, Again, just thinking about how, building some shared understanding of the problem. Let's say, if policymakers are saying, I want to address dealing with costs for people, I want to make life more affordable. They need to set some sort of perhaps goal or target for that, right? And so they might naturally be thinking, what's the dollar amount? Is there a number, a price point on the resources that families need, the wage point to make life affordable? And how does EPI, how do we at EPI think about how that number is different across different types of families, households, working conditions, cities, parts of the country? Can you speak to that a bit? Like, what do families need for things to be affordable?
Yeah, so it just so happens that EPI has the perfect tool for this. All of you can access it on our website. We call it the Family Budget Calculator. And what that does is it measures the monthly income that a family needs to attain a modest yet adequate standard of living, which is a standard of living above the federal poverty threshold. Those budgets estimate community-specific costs for 10 different family types from 1 to 2 adults, 0 to 4 children, and it includes housing, food, childcare, transportation, and healthcare costs. So just to give an illustration or example of the range of what it would cost, based on where you live. So if we're talking about a 2-parent, 2-child family in the San Francisco metro area, which also happens to have the highest cost of living in the country, we're looking at $6,386 per month. I'm sorry, $17,623 a month. I was looking at the wrong line there, which is over $200,000 a year to secure what we're calling a modest yet adequate standard of living. Over $200,000 a year, family of 4. If we look at one of the lower cost of living places, for example, Coffee County, Georgia, same size family, we're looking at that first number I was saying, about $6,300 a month, which is a little over $76,000 per year for that same sort of secure, yet modest standard of living. The website also has a lot of resources that people can use, including customizable fact sheets. You can plug in your specific place, family type, and get a fact sheet to sort of detailing what different costs are in the area. There's a map that allows you to quickly see how cost of living varies across the country. I think by county level is the finest, county and metro area. The full downloadable data set is available for folks to download and use. And then we also have tips for how to use the family budget calculator to construct a living wage standard for your county, state, or metro area. So again, lots of great resources and tools that people can use. Any of you can access it right now. We update it regularly, and I believe we have some plans in the works to do some additional updating and expanding that so that it continues to be useful for folks.
Perfect. Thanks for that, Valerie. And I hope everyone will check out that resource because I think it can provide great context for what affordability means in your part of the country, down to the county level. Okay, I want to move to some questions from our audience because we have so many. Just looking through here, and I'll throw this out to the panel as a whole, and maybe if you feel passionate about it, please jump in. I see one question here, just getting back to that question about prices, and how much prices factor into how we should look at solutions versus wages. Could you speak to regulations or policy proposals that affect price gouging or, price, profit-seeking behavior by corporations? Do you have thoughts on how that fits into this balance? Maybe start with Josh here.
Yeah, I would say a couple things. One, I would say like a constant, robust antitrust enforcement agenda will go a long way to making sure that prices are fair and not too high because of sort of excess corporate power. In terms of price gouging, I think a lot of that is depends on the circumstance. Like there are plenty of laws on the books right now for like when something happens, like a natural disaster, people are not allowed to raise the prices enormously for necessities in the area affected. That seems fine and good to me. I would say if you're talking about, you could imagine going back in time to like 2021 when we started to see that post-pandemic surge of inflation, which was largely driven by, the supply chain disruptions that the pandemic and the Russian invasion of the Ukraine caused. And you could have imagined in that environment if we had been really nimble and imposed an excess profit tax on corporations that basically said, relative to your profits the previous year, if you have huge profits this year that were driven by price gouging, you're just going to forfeit lots of that to the government. And that could have helped pay for some of the pandemic relief and provided some discipline on that kind of behavior. I think that could have worked. It requires extraordinarily sort of nimble policymakers, which it requires a law. And when I think of the US Congress, nimble is not sort of the word that leaps to the front of the mind. But I think there's a role for that. I think, especially as we go forward in a world where we might have more of those kind of terrible supply chain disruptions and weird things happen because of either climate or pandemic emergencies, being ready with some unorthodox tools to sort of clamp down on episodes like that would be a really good thing to have in the toolkit.
Thanks, Josh. There's another question here that, a few questions actually, that I think overlap pretty well about policies to increase wages. So, the questioner pointed out that there are some people who are against policies to raise the minimum wage because they are concerned that it will increase prices. And we got another question asking about a similar thing, specifically with the extremely low wages for folks doing the very essential work of working on farms or in food service, getting food to the rest of us. How do you see, is there a concern that increasing those wages will increase food prices or make affordability more difficult for other people? How would you guys address that?
I'm happy to start, but I will kick it over to anybody. Okay, so there is a lot of research into what, like where do increases in who pays for increases in minimum wages? And what that research finds is that increases in minimum wages do increase prices a little bit. It's little. And I wish I had, maybe one of you have some of the numbers off the top of your head, but like the increase in the minimum wage would increase the cost of a hamburger by 4 cents or something. Like they're actually really minimal increases in prices. So it's not a zero effect when you raise the minimum wage on the prices of things that low wage industries produce, but it also does not in any way boost prices enough to outweigh the enormous benefits of raising the minimum wage.
Can I say something on that as well? I mean, just it's just a fact that one person's income is another person's cost. And so I think that's, again, not to harp on this too much, but it's like just attacking prices as a strategy to ensure affordability because prices embedded in them are a lot of people's costs. And so it's not always super well targeted. And so I gave the example before of like childcare. Most of the price of childcare is the wages of workers who are already underpaid. And so a policy that just tried to push that price down would be a bad policy. What we want to do is figure out whose affordability we're trying to help and see what is the best tool to help them. And in the case of childcare, I would argue that is either subsidies to help people afford it or public provision that just took it completely off sort of private shoulders. So I think one of the disadvantages with just looking at a sort of price approach is it doesn't let you say these people's wages need to go up. And then maybe these people's wages, CEOs and highly paid corporate managers, need to be restrained. And so I think when you start thinking about it in terms of wages and incomes, you're able to target a bit better.
Can I add one more thing to that? I think there's a good historical perspective on this as well. The sort of turn to trickle down or neoliberal economics in like the 80s or wherever I often like put the start of that sort of in the late 70s and then really cemented with Reagan in the 80s. The whole thrust of that was All right. We are going to slam down things that support workers' wages, like the minimum wage, like unions and but the selling point at that time was, but it's gonna make things so much cheaper for everyone that really everyone will be better off. We know that that is not what happened. That is not what happened at all. What we saw is workers' real wages, so wages adjusted for inflation, just flatlining in the 80s and growing very slowly, for if you look over the entire last 45 years. So that bargain wasn't held, it didn't work. And so we really have to think of a different approach now that is gets at exactly what Josh says, where we have to just think very, very seriously about actually raising people's wages.
Thanks for that, Heidi. I want to ask one quick-ish question in our last kind of minute here, um, which may get at how we could get more momentum for policymakers to do something truly productive about this crisis. So we got a question about whether we could talk about the K-shaped economy, and if someone could maybe explain kind of what that is. And the context for this question was to say that maybe the pressure on policymakers to do something about this is high because people are, facing the sticker shock of higher prices, but also maybe it's not as high as it could be because consumer spending is still on a high level. Could you speak to that and what might be necessary to bring up to kind of push policymakers to action here?
I mean, I'm happy to start with my understanding of the K-shaped recovery is the idea that, economic recovery is instead of the economy being a single line that either goes up or down, there are different people in the economy whose performance can do very different things. And so you've got some people who might be experiencing very good economic recoveries over any period of time, and that's the part of the K that goes up. And then you've got other people who are experiencing something very different, and that's the part that goes down. I would say we have had a K-shaped economy for most of the past couple of decades in the United States. I would say the 2019 to 2024 period was actually one of the few times we really didn't when you look at sort of inflation adjusted wage and income growth. And yet, I think part of why people are so unhappy about their economic lot in life these days is one, they just don't like inflation. Even if you tell them their real wages went up, they just don't like inflation. It unsettles them. Totally fair enough. And then two, it's just true that, the economy could be delivering much, much more for low and moderate income families than it currently is. And the reason why it's not delivering more is because so much of the income gains have been concentrated at the very, very top for so long. Um, and so why this timing right now is that people seem so upset about that long run K-shape and economic performance. I don't know, but I think it's long overdue. So I'm happy to say if that does put pressure on policymakers to do something about it, I'm all for it.
Thanks for that, Josh. I so wish we had more time for Q&A because we got so many really thoughtful questions in, but I have to let us wrap. I want to let you all go back to your afternoons. Thank you for sticking with us, and we'll hope to maybe follow up in Q&A on some of the Q&A we weren't able to get to in another format. And I'll turn it over to Jen.
Yes, thank you everyone for joining us today. This was a lively discussion, and you can expect more of it from EPI over the course of the year. If you don't already, definitely visit epi.org to subscribe to our newsletter so you get the first invitation to things like this and chats with all of these glorious faces. And we hope to see you next week at our next event, who's got with author Dave Camper and talking about his book, Who's Got the Power. Have a great afternoon, everyone, and thank you so much for your participation and questions.